Hello, I am Joy from the Business Development Team at UOB Asset Management. Welcome to the United Income Focus Trust Year-to-Date Fund Review and Outlook webinar. As these are challenging times, we believe it would be helpful to provide our clients with regular and timely updates of our fund's focus and positioning. To begin, I'm pleased to welcome Darmo Sargento, Senior Director, Head of Investment Partnerships and Solutions, and Chief Investment Strategist of UOB AM Invest, to give an update.
This year, the combined shock of the coronavirus pandemic and the collapse of oil prices has caused one of the steepest market sell-offs ever and drastically increased investors' uncertainty. During the market correction in February and March, we saw global equity markets falling by 30% from their peak, with global high-yield credits declining by 18%. On the other hand, UIFT has held up relatively well with a drawdown of 16%. Since the market correction, risk assets have rallied in April as the rate of increase in new COVID-19 cases seemed to slow, the Federal Reserve expanded support for credit markets, and oil price rallied on hopes of a global supply cut. On a year-to-date basis, we continue to outperform risk assets. This is due to our emphasis on better liquidity and higher quality in our portfolio. In addition, our ability to adjust the portfolio effectively as markets change help our performance, which will be illustrated next. As the coronavirus outbreak unfolded, we saw unprecedented volatility as markets sold off and the risk management tools within the portfolio engaged in a timely manner, resulting in us reducing our overall equity exposures from 50% to 14%. Equity exposures have risen modestly to 17% in April as volatility subsided and valuations become more attractive. While we have increased our credit exposures marginally, we are focused on identifying pricing inefficiencies and continue to position the portfolio towards higher quality issuers in global investment-grade credits, which are trading at attractive valuations and will benefit from central banks' liquidity support. We started out with a duration of 5.1 years to act as a diversifier to equity risk. However, taking into account the bond rally in the last 2 months, we have trimmed our duration exposures to 3.7 years. This is largely a valuation call, based on a view that monetary easing should be largely priced in by markets now. Our alternative exposures into global property and European financials have remained reasonably consistent throughout this period, with most of the focus on alpha generation within each allocation. Although the total returns have been challenged, alpha potential has been strong, and we believe that will continue to be the case. Our base case is that economic recovery will be a U-shaped one, with slow reopening of the global economy as infection rates gradually fall and medical treatments become available. We do expect recession to last most of 2020 as the fallout of COVID-19 begins to show up in economic data and corporate earnings. From this recovery, equity markets may grind higher with credit spreads compressing slowly while interest rate remains stable. From here, we will increase equity exposures as volatility falls and take on more credit risk while tactically trading duration. The post-COVID-19 environment will present opportunities for us to identify winners and losers among companies and sectors, thus security selection will be important. We have seen one of the most rapid sell-offs in markets ever, but not the deepest. There is still a chance equity markets may fall further with an L-shaped recovery. If that does happen, our defensive posture should mitigate the worst of that scenario. Conversely, if we see markets stabilizing from here and begin to climb higher and faster with a V-shaped recovery, our investment process should also adapt quickly. It's our expectation that due to the extent of monetary and fiscal support currently being provided by governments and central banks, the recovery in financial markets when it arrives will be swift and steep, even if the real economy may take a little longer. It's worth highlighting again the highly dynamic nature of the portfolio. Similar to how we reduced risk quickly as the crisis grew, we can equally re-risk as the crisis shows signs of receding. In this challenging and uncertain market, we think UIFT can offer investors genuine diversification across a range of asset classes, the ability to dynamically shift exposures in response to rapidly evolving markets, and discipline and multi-layer risk management to help mitigate an array of market risks. Even when markets are uncertain and volatile, the fund has been providing stable payouts of 5.28 cents per unit per annum on a monthly basis since February 2016. With UIFT's consistent income, combined with its diversified, dynamic and disciplined approach, this affords our clients the comfort of worrying less about timing. We would recommend clients remain invested and, to the extent possible, think about dollar averaging their exposures.
Thank you very much, Darmo. To our clients, thank you for your time and for allowing us to help you manage your money. We would also like to hear from you. Kindly scan the QR code on the screen to share your feedback. Please look out for our next update on the United Income Focus Trust. In the meantime, stay safe, stay healthy, and stay united.